Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoy this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Luni Libes of Fledge, global network of conscious company accelerators and impact investment funds. Luni, thank you for joining us.
Oh, thank you for having me.
So what was your background before starting to invest in early stage companies?
Well, I'm a serial entrepreneur. I started my first company back in 92. I spent 20 years doing tech startups. And then at the 20-year mark, had one of those midlife moments where I got to sit back and decide what to do for the next 20 years. And I decided to start a business accelerator. And in doing that, started investing in startups.
That's great. So you've seen a lot of startups on both sides of the table as an entrepreneur and as an investor. We have a lot of investors listening to the show, and we always ask, what's your advice for people that are just now starting to invest in startups? What would you advise them to do before they actually do it?
Well, I would, first of all, take your time. The key is to see as many deals as you can before you jump in with 2 feet. But also to take a few steps back and look around and question everything. One of the things that I do that's different than a lot of other investors is I invest in a form that's not typical. I invest in a form called revenue-based equity. And I did that because I'm investing in sectors and geographies that are not common. I'm not only investing in tech, I'm investing in other stuff. And so when I decided to start this business accelerator, I decided to question everything and wonder, why do VCs invest the way they do, and why do angels simply follow what the VCs do? And is that the right answer or not?
Well, that's great. That's great. So you're in the revenue-based funding world, and you've probably seen quite a bit there. How do you see the industry evolving with it these days?
Yeah, so I started in revenue-based equity 7 years ago. An older investor taught me how to do it in the form of equity. It had been done in the form of debt by about half a dozen firms before that. And it's coming along. So every time I go and talk about this in public, I find yet another investor who's using the terms. But it's still not mainstream yet. It's still pretty unknown. So 2 most prolific firms in the entire world happen to both be based in Seattle. One's called Lighter Capital. They do revenue-based debt as growth capital for tech companies. And the other one's called Fledge, and it does revenue-based equity for startups all around the world.
Can you talk a little bit about what those terms are and how it differs from revenue-based funding on the debt side? I think people have heard of that, but maybe not everybody's heard of the equity version. How does that work?
Yeah, usually the way that I describe this is the normal way you invest in a startup is you hand them some money and they promise you nothing, right? Technically, they're promising you a percentage of the company, but they're not promising to pay you anything as an investor. So you have an unknown amount of time for an unknown payout. And you do that on the hope that someone wants to buy this company eventually. But again, as I say, question everything. If you look at the statistics of what actually happens, 1.5 out of 10 companies that the VCs invest in have an exit, right? Maybe 2 out of 10 in a good year. And those are on the coasts, right? In the middle of the country and then outside the US, it's way less than 1 in 10. And so instead of doing that, what we do is we invest money in a company, and they promise to share back with us a small percentage of their top line revenue. And in the debt form, that's it. They're just paying you back a percentage of revenue until a certain amount of money is paid back, right? Usually a fixed amount of like 1.5, 1.8x what you gave them. And in the equity form, that little share determines how many shares they buy back. In short, you're buying shares, they're buying them back. They're paying you more than you paid them. And we typically do a 2x or a 3x on that payback.
And what kind of success rate are you seeing with that model as far as getting the returns you expect?
Well, it's a little too early to give you key statistics. We got at least 5 more years to wait to have those. But overall, we have about 78% of our companies are still up and running, and therefore 78% still are paying us back, as opposed to, again, the typical model of put in money, you'll get a bunch of losers in the first few years, and then your winners you don't know for 5, 7, 10 years.
What is the biggest impact on returns when a startup comes to you and that wants to do this? What do you look for that really tells you this is going to be a good one, or we're not so sure about this other one?
What's really different about this model of investing than the typical model is that we're just looking at, can the company earn revenues? We're not looking at who's buying companies in this sector and what are the multiples on revenues and profits that we're seeing in this sector. We don't look at any of those stats. We're really just looking at how much money did this company make last year? How much are they going to make this year? How much do we think they'll make in the next 5 years? And what's that sum total in revenues? You multiply that by, let's say, 5%. I say single digit percentage, usually 4, 5, 6, 7%. So multiplied by 5%. Is that twice as much as they're trying to raise? If so, could be a good investment. It's really as simple as that.
So what's your investment thesis for this sector? What is your specific criteria to engage or take on a company versus not? Aside from the metric you just gave us, are you looking for a certain revenue to begin with? Do you look for certain growth rates? Are there any other things you look for?
Yeah. So when you did my little intro, you said impact investing fund, which is also a little bit different. So the general thesis is there are big problems of the world. Right. We're not investing in trying to save a dollar or save a minute for Americans. We're actually trying to solve global poverty and global health and hunger and climate issues, right? The big problems of the world. And we don't do it with one check in one company. We do it with lots of little checks. And the thesis is that we can make a difference with those big problems using for-profit companies as the solution. And the underlying hypothesis below that is that we're not going to solve these problems with charity. We've tried to do that for 50 years. That didn't work. Same thing with governments. That the only method for getting to scale for, let's say, climate change is the for-profit sector. And the only possible way to make a big dent in poverty is the for-profit sector. And that sounds crazy, but it worked for the US and Europe. There weren't a bunch of NGOs here that pulled the first billion people out of poverty. So that's basically what we're looking for, is sums up to what we call mission-driven for-profit companies. And that sounds a little bit non-profity. So let me give you some examples. We just graduated 6 companies. One of them makes honey. So that doesn't sound very impactful, but they do it in Botswana. And it's solving a few different issues. One of them is that Botswana is a country where you'll find the most elephants, wild elephants, just roaming around. And one of the places that they roam around to is onto people's farms, because that's where they'll find food. So how do you keep the elephants off the farms? In every other country, they keep them off with guns. In Botswana, until recently, it was illegal to shoot the wild elephants. So this company is keeping the elephants off the farms with bees. Turns out that elephants don't like bees, just like people don't like bees. And so if you put beehives on the farms, then the elephants stay away. And then if you put beehives on the farms, you get better crops, you get better yields. And if you put beehives on the farms, you have a second form of income. And then comes the problem of what do you do with the honey? So this is a honey aggregating company. It's not a farm. And they aggregate the honey and they package it up and they sell it in the stores. And actually, they're selling so much they're started to export to neighboring countries.
Well, that's great. And that's a good example of a revenue-based funding opportunity, it sounds like. Are there any others?
Sure. So one here in the States is called Fuchsia Shoes. That one's called Kalahari Honey over in Botswana. This one's called Fuchsia Shoes. It's a startup by 2 techies. 2 techies came here 10 years ago from Pakistan. So the CEO, she quit Microsoft. She decided to start a company. And what they do is they work with artisans over in Pakistan who know how to make shoes. They make shoes, and then Fuchsia sells them here and in Canada and an e-commerce site. And they started with women's ballet flats, which is a traditional style, or fairly traditional style from Pakistan. But they didn't just take the shoes off the shelf there. They actually updated them and made them more robust and more comfortable and higher quality. And so they're employing a few hundred artisans in Pakistan who otherwise would not be earning even the minimum wage over there. They've increased their salaries by a factor of 6, and they're selling lots of shoes here.
Well, it's great. It's a great impact investment as well as a great investment by itself. So it sounds like it worked out very well. As you've done these revenue-based funding deals, what do you find is the biggest challenge in making them work and working in this space?
My biggest challenge in my work is finding enough investors to invest in these companies. And so unlike the world of investing in startups, most of the buzz is around tech, right? A little bit in healthcare, but almost every investor in startups is seeking the next big Facebook, Google, next tech company. And so there's very little money in comparison that are trying to solve poverty and hunger and climate issues. And so we just get constrained. So the kind of companies we're finding tend to be $100,000 a year, $200,000 a year, maybe $500,000 a year, trying to get to $1 million and doing it with hundreds of thousands of dollars, not with millions. And so we're kind of playing with fewer zeros. Growing companies a little slower because we have less capital to grow, and we're finding fewer investors and fewer funds to do follow-ons.
So you see a lot of applications and subsectors in this revenue-based funding space. If you had to pick 2 or 3 that were really good opportunities to pursue, which would you put at the top of the list?
Oh, man, just too many. So one of the nice things about running an accelerator as opposed to just being an angel investor is the amount of deal flow we see. So I'm personally seeing something like 10,000 companies a year, just cursorily. And then in terms of details, we just went through 450 applications for the session we just finished. And so I see opportunities all over the place. We had applicants from 85 countries doing everything you could think of, including blockchain and drones and AI. And we had to whittle that down to 6.
Wow. Seems like there's a wide range of opportunities where it could work. So it is a very versatile tool, it sounds like.
Yeah, the only place that in all the rounds I've made to all the different conferences talking about this, the only pushback I've gotten saying it won't work is in biotech startups where there's no revenue before an acquisition. In that case, there's no revenues. A, you can't do revenue-based investing, and B, I don't take that kind of risks. I'm pretty risk averse, but that's a little bit crazy in my book.
So for your accelerator, do they have to have revenue when they walk in the door, or do you take them pre-revenue with the hope that they will generate revenue in the near future?
More often than not, they already have some revenue. We use that as kind of proof that what they're doing is desired by customers. But we just had 1 out of the 6 that had no revenue. In fact, it wasn't incorporated, still not incorporated. And they're bringing micro hydropower to Western Kenya. So 100 million people live without electricity around Lake Victoria. There's hills, there's year-round streams. We know how to build electric grids and charge people for electricity. There's no invention needed here, but it's just not being done. So we're going to go do it.
Well, that's great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
Yeah, we should cover what else investors can do besides write checks.
So I assume your companies need mentorship, need contacts, need key team members. So what else would you think investors could bring to the table?
Yeah, they bring all sorts of things. So again, one of the nice things about running an accelerator is we start out with a small check. So we're running a program that invests in every company that comes in, but we simply start with a $20,000 check. And we then get 2 months of not just helping them, we get 2 months of, you can call it due diligence, to help rebuild their business plan. And so we bring in all sorts of people to help with them, some of them investors, some not. But they help with everything in terms of strategic planning and financial modeling and marketing planning and sales planning and whatnot. And that's kind of a key when it comes to startups, is that entrepreneurs need help. First-time entrepreneurs need help. They don't even know what they need in terms of help. And it's useful for investors to bring more than just cash, to bring their network, to bring their experience. And it helps to come in with the mind that I want to help these companies with more than just capital. Because what I teach the entrepreneurs is, as soon as you have an investor, now you have a business partner, right? Whether you really wanted one or not, you wanted capital that comes with a business partner. You now have to keep them in the loop, and it's a two-way street, right? As an investor, you got to do what you can to help the companies you've invested in. It's not a passive role.
Absolutely. So how best for listeners to get back in touch with you?
So my personal website is lunarmobiscuit.com, which is a mouthful. You'll put it in the show notes. And on there, you'll find a blog where I give advice to entrepreneurs and investors. You also find my podcast on there. I've been podcasting. I got a book series for entrepreneurs and one on revenue-based investing for investors. Other hat on, you'll find me at fledge.co, and that's my accelerator. And either of those sites have contact pages if you want to reach out and send me a note or ask me a question.
Well, great. We'll put those in the show notes so people can get back in touch with you. Thank you for taking time to share that with us today, and looking forward to a follow-up soon.
Sure. Thanks for having me on.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.